Hi, my name is Yasuki Okai. I work for NRI, Nomura Research Institute. NRI is an IT and consulting company in Japan. And I'm working for NRI and in research division for IT industry for more than 20 years. And today, I'll make a presentation titled COVID-19 pandemic accelerates the paradigm shift in Japanese financial industry. So I'd like to show you the rough structure of this presentation. First, in spite of being referred to as a new paradigm in finance, it actually already appeared before the COVID-19 pandemic. However, all the business customs have been a hindrance that prevented the industry overall from transitioning to the new paradigm, and the shift has stalled. I'll touch on how the outbreak of COVID-19 has made it possible to remove the obstacles that are blocking the paradigm shift. Further, I'll explain what this vision of finance under the new paradigm looks like. And finally, I'll speak about service providers' role in helping this financial paradigm shift. This slide briefly describes the key concept of this presentation. This ball or circle stands for finance. Before Lehman crisis, the finance ball used to be stable at the unique bottom of basin. Let's call this stable status of the finance ball the old paradigm. Then after Lehman crisis, there appeared another bottom of basin with modification by the pressure from society demand or authorities' requirement. Let's call this new bottom the new paradigm. We could already see what the new paradigm looks like vaguely before COVID-19. The COVID crisis, but however, old business customs have been obstacles that prevented the finance ball from transitioning to the new bottom. A small mountain in the middle stands for that obstacles. The COVID-19 crisis had occurred, and which is making the mountains of obstacles smaller and smaller by changing our norms and conventions, and which has made it easier for the finance ball to move. Moreover, service providers' activities which support financial industry revamping the cost structure is making the mountain even smaller. Based on these changes, the finance ball is about to move to the new bottom, the new paradigm. So this is a rough sketch of today's presentation. So let's move on to the main part. The chapter 1 has a new paradigm appeared before COVID. First, this shift to the new financial paradigm was going on before the COVID crisis hit. When the Lehman Brothers collapse happened, it became clear that the financial industry thus far had become dissociated from the real economy. In light of this lesson, the financial authorities in particular set a new course, aiming to create a financial system for long post-Lehman world that would contribute to the real economy. In the world of pre-Lehman finance, it was considered only natural that finance should be lucrative as just another type of industry. The belief is that the result of money-making activities are all that mattered. And those results vindicated the nature of the investment. People believed that power of the market was absolute. And as long as liquidity increased, the overall economy would be guided toward an efficient status. However, following the Lehman Brothers collapse, a movement was born that sought to revise the old paradigm under the banner of finance that contribute to the real economy. The financial authorities also began issuing a number of directives calling for existing business practice to be corrected. As a result, we find ourselves in a situation where people are wondering what aspects of existing paradigm are to be changed, or if financial institutions are permitted to make money, and what exactly the new paradigm is supposed to be. Now, let's explore the hints concerning the new paradigm from the actions taken by Financial Service Agency, FSA. After the Lehman Brothers failure, and especially from 2015 onward, there has been an increasing recognition of the need to transition to a financial model that contributes to the real economy, in line with the wishes of then FSA Commissioner. The guidance being given is very wide-ranging, but broadly speaking, these activities can be aggregated into two categories. The first is directives to regional banks to take actions which benefit the local economy. The other is guidance for distributors and asset managers, who are direct financing players, with a message to conduct themselves in ways that contribute to sustainable economic growth. Against that backdrop, the FSA's thinking is that money from regional banks is not reaching to local companies that have growth potential, and also that the flow of funds through direct financing is not functioning as a system for screening superior companies. This FSA's thinking can be supported by several evidences. There is some on this slide. The left chart shows regional banks operating profit from core business. By the way, the unit is missing on this chart, and the unit is trillion yen. During these 12 years, the number had decreased by 40%, which suggests the fact that regional banks' role in local economy is shrinking, and the current business model is approaching the limit. The upper right chart shows financial assets held by household, with the comparison of the number of Japan and the US and the EU. You can see the big difference of risk-asset ratio among them. US number 51% is almost tripled, and EU's number 28% is almost doubled, against Japan's number 14%, which come from the summation of 10% and 3% and 1% on the chart. The fact is sometimes mentioned as the evidence of big opportunity or big potential of Japanese retail financial market. But why risk-asset ratio in Japan is so low is still one of puzzles. And this fact is also mentioned as the evidence of immature direct financing in Japan. The lower right chart shows the outstanding of Japan's mutual funds. You can see that the number after 2014 is almost no growth. This is also one of evidence which shows immatureness of Japan's direct financing market. Next, let's take a slightly closer look at the FSA's directives. First, I'll discuss the directives for regional banks. If you look at a statement made by FSA Commissioner to regional banks, they are clearly urging these banks to transform their business models. Of course, this is partly in the interest of emerging banks whose business foundations have become unstable in the low interest rate environment. But in fact, the FSA wants banks to properly send their funding to growing regional companies in order to contribute to their local economies. Hence, emphasis is placed on carefully evaluating the business viability of companies. Of particular importance is the fact that financial institutions are being asked not to pursue profitability as their own main goal, but instead to contribute to the development of regional economies overall and to generate revenue in that process. In a nutshell, these banks are being asked to play the role of platformers for regional economic development. Thus, regional banks are being forced to run various reforms. They are faced with having to make bold changes, with directives to drastically cut costs to get the resources they lack from outside, to utilize digital technology in overcoming resources shortfalls, and to refrain from listing themselves on the stock exchange if listing itself would impede their long-term efforts. On the other hand, when it comes to direct financing, banks and securities firms serving as distributors are being required to make their business management more customer-oriented. And the pension and asset management firms are being told to adhere to stewardship codes. And finally, large corporations are being made to follow strict corporate governance codes and improve their information disclosures. All these things are intended to attract long-term investors and establish long-term investment practices. And in doing so, to help screen and identify superior companies and contribute to economic growth. In particular, ESG elements have recently become a prominent aspect of cash flow, and they now become very important as financial practices that contribute to sustainable economic growth. This slide summarizes the suggestions made by the financial authorities thus far. More specifically, in order to encourage a shift towards the finance that contribute to the real economy, the authorities have sent certain kinds of messages. For example, they have told regional banks to focus more on evaluating the business viability of target companies, while advising distributors to make effort to attract long-term capital, and instructing asset managers to make ESG practice more mainstream as long-term investment opportunities. I believe there are three common hints or insights into the new paradigm that can be extracted from these messages. The first one is they emphasize the point that financial institutions should seek to prosper together with the growth of the market, rather than through seeking profit directly. To put it in another way, I think they are expressing a desire to see these institutions transform themselves into platforms. The second hint is that financial institutions must have a long-term perspective for their guiding principle. Not only does this mean selling products that are managed from a long-term viewpoint, it also means their perspective in managing their own business must be long-term as well. The third hint is to look carefully at what you are investing in. This also involves the idea that an investor's relationship with the company doesn't end when the money is paid. It continues beyond that. You can see upon comparison that these hints are entirely at odds with the finance-centric paradigm that came before. The chapter to the current state of stagnation. So far, I've told that we could already see what the new paradigm looks like even before the COVID-19. In the next chapter, I'll talk about the fact that the financial industry could not move forward, although the direction to the new paradigm was shown. I've described how one of the messages that the authorities have been sending is for these institutions to become platformers. However, this is no easy task. What is needed for these institutions is not to strive for their own short-term profit, but instead to bring in revenues with a long-term perspective, hand in hand with market expansion. This will be very painful for the banks that are expected to make that transformation. There certainly are hopes for the market to grow. For example, I've spoken about the possibility that risk-asset ratio by household might go up, and we might be able to expect revitalization of regional economies. Besides these, there are several fields, including the senior assistance business market or startup support market, in which the emergence of platformers is anticipated. However, to make this a reality, there need to be transformers who can collectively convert non-competitive fields into common functions. This is a change that will need recombining current business setups. It will be a painful process. It's clear that this will not be a simple thing to do. I have also described how the players in direct financing are being forced to adopt long-term business models. However, this too is no simple matter for the parties involved. Current business is focusing on the short-term investors. Distributors make commissions through providing financial products which matches the client's needs. And they also request the agility from asset managers to provide products according to the trendy theme rather than long-term performance of the product. Because short-term investors tend to be tolerant of commission rate, asset managers can set high trust fees and give distributors high incentives from them. Thus, there is a relatively stable relationship among short-term investors and distributors and asset managers in Japanese retail market, which is supposed to be comfortable for each party involved. However, under this business model, we cannot expect new type of customers coming in. And to change the status that there is still more than 1,800 trillion yen staying in deposit from household asset. Many people have already noticed that the business model itself must change now. On the other hand, switching to a type of business that focuses on long-term investors will lead to a total change of current business setups. Distributors are supposed to provide financial products which match to those long-term investors' need and with some advice. Asset managers are supposed to provide long-term products with high performance rather than trendy products. And compared to short-term investors, long-term investors tend to be sensitive to commission rate, which will force asset managers to set lower trust fees. That's why switching to the new business model will mean a temporary drop in earnings for these distributors and asset managers. There is even a chance that this drop in earnings may not be temporary. While many companies are taking on the challenges of transitioning to a long-term business model, there aren't very much successful examples out there yet. So ultimately, the financial institutions themselves are opposed to what the authorities are asking, and they are unable or unwilling to embark on this path of change for various practical reasons. I showed here several reasons. These include the following. We don't have enough personnel to undertake these new activities. It doesn't pay. We cannot explain this to our shareholders. This is face-to-face business, so we cannot cut our operating costs any further. We won't be able to pay our employees' salaries, or our clients aren't asking for it. Distributors won't sell either. So we can see here that there are several common factors behind these reasons. One of them is difficulties in resources allocation. And another is short-term result-oriented business convention. And another is the values of clients like ESG interests and so on. This image we have here represents the current status of stagnation. We have the old paradigm by which traditional finance had thus far existed stably, and we also see the new paradigm being formed to which the finance industry will have to adapt itself for the demands of society and directives from authorities. Yet, as the image shows, companies are facing resource issues and having business customers that are blocking the way and preventing them from switching over to the new paradigm. Then let's move on to the chapter 3, the impact of the COVID crisis. Then the COVID crisis happened in this stalled situation. COVID-19 directly attacked two elements of conventional wisdom, namely how we approach an uncertainty about the future and how we understand real value, that is, how we view the value of face-to-face interactions and of physical branches and offices. Furthermore, these impacts have led to revisions of various norms. For example, they've led to shift from growth to sustainability, or from efficiency to stability, or from urban to rural, or even from corporate to private. Because our norms and conventions are being changed on such a broad scale, it's now possible that former obstacles to the paradigm shift will no longer be a hindrance. It was thought that switching to a long-term business model would make it difficult to pay employee salaries. But as new hiring patterns or working styles spread, this might not be an obstacle anymore. And although it was believed that individual investors wouldn't be attracted to ESG investment, we might well see a growing interest in this area. Clients who may have been unwilling to meet online before are now interested in online interactions, and this will also have an impact on the necessity of physical branches. In terms of how the COVID crisis has affected the paradigm shift, we can probably say that COVID-19 has done a lot to reduce the obstacles involved. As shown in the image above, the COVID crisis has chipped away at the mountain of obstacles that was impeding the paradigm shift. This has made it easier for the finance industry board to move to the new paradigm bottom. Let's move on to the next chapter 4, a new vision of finance under the new paradigm. Now let's take a closer look at what the new finance after the paradigm shift could look like. In this slide, the old and the new paradigms are arranged in a side-by-side comparison. The left-hand side is the old one, and the right-hand side is the new one. The features of the old paradigm could be described as colorless money. Short-term trading is the core of investment here, and secured loans is the core financing. While for corporate transactions or private transactions, the relationship is basically over when monies are paid. By contrast, the features of the new paradigm can be called colored money. When monies are to be paid on situations like ESG investments or evaluations of business viability, you look at the substance or inside of the transactions involved. And the relationship continues even after the transaction has concluded. With corporate transactions, the trading partner's supply chain is checked for any human rights issues. And with private transactions, e-money and the like can be used to grasp a client's individual attribute. Where the old paradigm emphasized freedom on colorless money, the new paradigm would place more restrictions on freedom with colored money. However, for this very reason, we could go from the aggressive go-for-it economy under the old paradigm to an economy with feedback with the new paradigm, and which would lead to an economy that can solve society's problem. And IT and digital technology have contributed greatly to efficiency gains under the old paradigm too. But on the flip side, they have also promoted economic inequality and disparities. With the new paradigm, digital technology will become essential as an economic neural network. I'll explain a little bit more about finance under the new paradigm here. This slide summarizes 4 aspects about the new paradigm. One is about the relationship between finance under the new paradigm and the style of economy. That is the right side chart. And another is about the direction and the possibility for the retail finance to evolve. This is upper right chart. And another is about the room for the finance to expand. This is bottom left side. And the other is about the pain for the parties involved for this paradigm shift. The top left on the summary slide merely shows that finance under the new paradigm supports sustainable economics with feedback. Especially in Japan, we call this type of new economy Society 5.0, and featured one of priority policies by Japanese government. By combining money and information together. In other words, by making money colored, the feedback loop stabilizing current economy will be implemented. The top right on the summary slide shows the finance under the new paradigm has plenty of room for creating more value added. I'm not simply recommending that companies earn more by attracting long-term investors to retail finance, which has thus far mostly involved short-term investors. Rather, I would involve providing opportunities for social participation through solving society's challenges. This means that finance would function as a voting system for solving social problems. The range of services offered by financial institutions that support this effort would likely expand as well. The bottom left on the summary slide shows how there is also plenty of room for market expansion, under the assumption that the role of finance would be extended like the previous slide. For every social problem that exists, a new platformers can emerge and create another new market. Finally, the bottom right on the summary slide indicates that the transition to the new paradigm cannot happen without revamping the current business cost structure in the industry. As we see, this shift will bring a great deal of pain for companies in the transformation of their business model. In addition, the role of ESG investment in finance under the new paradigm is expected to change significantly. In fact, the presence of ESG in business with institutional investors, especially in Europe, is growing enormously. However, those people more involved in retail business tend to believe that ESG isn't lucrative. And there are some people who have an aversion to the word ESG. One major misunderstanding is the belief that ESG investment performs poorly. But in fact, ESG investment came about as a result of pursuing long-term returns. I expect that by going through a process of resolving these misunderstandings, we will see ESG become more mainstream under the new paradigm. If we take a historical perspective, the new paradigm in finance corresponds to modified capitalism, which includes the essence of Society 5.0. By contrast, if we look at the relationship with China, which represent modified socialism on this chart. We see that compared to the time of colorless money, the growing shift toward colored money puts us at ever higher risk of conflicts involving our norms and conventions. For China, this may mean more pressure that appears as domestic intervention through finance. The final chapter towards a gentler transition. As I discussed, it's possible that the COVID crisis could make the paradigm shift a gentle one. Even if the COVID crisis hadn't occurred, the environment surrounding the financial institutions has grown more severe with low interest rates and low margins. And so it's possible that the old paradigm could eventually have collapsed on its own. In this case, the paradigm shift would have inevitably been a hard landing. Conversely, the COVID crisis has revealed a soft landing scenario for the paradigm shift. These days, we can see many activities by service providers which support financial institutions to become platformers. Some of them are IT vendors, which offer shared type service for IT infrastructure. And some of them are financial players like online securities firms, which offer an application service supporting regional banks' new business functions. These activities will further reduce the hurdles to this transition and will help make the paradigm shift a gentler one. This slide summarizes the issues I've discussed. Although there were signs of a change in the paradigm for the finance industry before the COVID crisis, the shift had been difficult under the existing paradigm, and we found ourselves in a sort of stalled situation. Then the drive toward a new normal after the COVID crisis lowered the hurdles that were blocking this paradigm shift. And many activities conducted by service providers also guide the financial paradigm shift to a softer landing. This is how I see the business environment. In light of this, my final main message is that we must realize that Japanese financial industry is at the biggest turning point during these 30 years history, and how financial institutions correspond to this big change of environment that will determine their new position in the new world. Thank you very much for listening today.